it's not that the best companies are the best because of AI. It's that the companies that have the most healthy urgency are able to deploy AI in a way that creates incremental value.
Hello, and welcome to Electrifying Growth, a podcast brought to you by Edison Partners. I'm Chris Sugden, managing partner here at Edison and your host. There are moments in a person or company's journey that are undeniably electric. The spark or sparks, if you will, that propel you or your company to new heights. With Electrifying Growth, we're here to have in-depth, real conversations with great leaders who have been there and done it before. Edison has been investing in high-growth technology companies for more than 35 years, and I have been here at Edison doing this investing piece for more than 20 years. We've led over 225 investments. We understand that it takes great leaders and visionaries to build market leaders. We are your support system, a CEO and management's entourage, if you will. Let's introduce this episode's guest.
Hi there, I'm Chris Sugden. Once again, your host of Electrifying Growth. Really excited with today's guest, Ben Laufer, actually one of my colleagues here at Edison Partners. He's a principal. Ben has spent his career at the intersection of investing and operating. Also, as a founder himself, he understands what it takes to build something from the ground up, which he's actually done a couple of times. As someone who's written the check and someone who's done the work, he brings a rare ability to see growth challenges from both sides of the table. Something actually we pride ourselves across the board at Edison. Most of the investing partners and principals have both operating and investing experience, really invaluable. Today, we're diving into the 2026 Edison Growth Index. We've been publishing the Growth Index for almost a decade. Ben shares what the research uncovered about healthy urgency and the three pillars that drive it: alignment, efficiency, and sustainability. And we're going to double click on the way all three must be present or you're not going to see success. We talk about which financial and operational metrics actually predict growth, why customer retention is the most powerful lever available to SaaS companies right now, and what data shows about AI. Importantly, what you're going to find and hear about AI is it will accelerate your current state. So if you're not aligned, it'll actually misalign you even faster. If you are aligned and you have strong efficiency, it'll speed all of that up. Specifically, how your level of AI adoption can either compound your growth or quietly accelerate burnout across your organization. Ben Laufer, welcome to Electrifying Growth. Thanks for joining me today.
Thanks. Long-time listener, first-time caller. Glad to be here.
Yeah, exactly. And for those who did listen to the introduction, no, we're not skimping out on guests. And yes, Ben is part of the Edison team here. But because we have the Growth Index, which we just published, and Ben was the leader of that, I thought him joining us as a guest today would be really apropos because there's some really interesting stuff in our Growth Index. So Ben, as we discussed, we're going to double down on some of what's in the Growth Index. Before we do that, though, I just want to make sure I introduce the Growth Index properly. Edison's been now publishing this index. I think we're getting close to 7 or 8 years worth of growth indices. An annual sort of survey, we try and pick a topic that we think is helpful, growth obviously being really important for growth investors and tech companies, but trying to then survey and use our portfolio companies' data as a way to find out what's working and what's not. And sort of truth is in those responses. And with that, this year, Ben, why don't we do two things to kind of kick this episode off? Talk a little bit about what the topic of the Growth Index is, and we're going to really dive deep into that, but also talk about a little bit of the, call it, methodology used to develop this year's findings. But first, start out with what was the theme of this year's, the 2026 Growth Index?
Yeah, sure. Happy to. Well, first off, I'd be a derelict if I didn't give a shout out to Nani, Bobby, Shelby, and Sal, who were very instrumental in this year's publication. And yes, I got to put my name on the cover, but they did a lot of the heavy lifting. So shout out to them and thank you for all your efforts. So this year, the Growth Index was about healthy urgency. And one of the things in our annual meeting was focused on, the more things change, the more they stay the same. But despite all the macro volatility that we've seen in the last handful of months, we've realized that healthy urgency is one of those things that endures and is mission critical. And we decided to spend a little bit more time with our portfolio companies looking under the hood of what actually healthy urgency entails. And as we had conversations with various different stakeholders, CEOs, other members of the ELT, our operating partners, advisors, EDNs, we realized that healthy urgency can boil down to 3 fundamental attributes. That's alignment, efficiency, and sustainability. And so we spent a lot of time surveying members of the portfolio, board members within the Edison family, and aggregating a ton of data financially and both qualitatively and quantitatively to evaluate each of those three things again: alignment, sustainability, and efficiency in a more granular level.
Let's just go one little bit further just to tease this out. How many people are we talking about here? Kind of data points. And by the way, we should give a shout out. We'll do this, now and at the end. You can get our growth index from our website. It's something we share for those who might be listening out there and hadn't seen it yet, but sure, kind of, it seems to be statistically relevant given the number of data points we covered, but just share a little bit more on the who participated.
We're very fortunate to have a very engaged portfolio and members of the community. We had 66 portfolio company executives spanning various different vintages of funds. And then we aggregated on top of that over 2,000 financial data points, everything from retention data to customer health and metrics related to customer success, both on a gross and a net revenue retention basis. We looked at revenue growth. We looked at profitability. We looked at how sales and marketing dollars were actually converting to revenue over 12 and 18 months of forward periods. And so it was a combination of, again, qualitative surveys from ELT members spanning 3 funds, 66 executives in total, and over 2,000 financial data points.
Very cool. Okay, you said healthy urgency can be defined sort of in 3 ways or 3 key pillars of efficiency, sustainability, and alignment. Do you want to just define those a little bit, each one of those, and then let's dive into what the data kind of said as well.
Yeah, happy to. So let's start with alignment. And then if you have any questions about that, I want to go deeper, we'll pause there. But alignment is essentially how are the CEO and ELT members paired with the board members thinking about priorities for the next 12 months? So for example, one of the survey questions that we asked each member that we polled, what are the top 3 priorities for the next 12 months? They can be things around go to market. They can be things around product and technology. AI is a big topic today. And we normalized the survey responses into various different categories. And we compared them across, again, key stakeholders. And we ultimately tried to measure how aligned each of those stakeholders were.
Awesome. Now, there were kind of 3 big findings as I sort of reviewed the data and thought about it that were in here. We also have some really interesting financial kind of metrics and non-financial metrics that kind of gave us some interesting story. But let's start with the findings. And the first one that clearly sticks out here is alignment, efficiency, and sustainability. None of them really act alone, I think is the simplest way I'd say it, but I want you to kind of expand on that. And there's some, like, again, you provided some data, the team provided some data statistics to kind of back that up. But what did you mean by no single dimension predicts financial performance?
Yeah, sure. Well, why don't I just very quickly define both efficiency and sustainability? Efficiency is how we think about how spend converts to performance, the number of dollars that it requires to create uplift in revenue, for example, and how long that takes. And then sustainability is, okay, it's great that you can get those dollars to convert to value over the course of 3 or 6 months, but 18 months forward, were you able to sustain the pace of that investment, both on a quantitative metric basis and also with respect to things that are also critical, like employee retention? Like, are we able to actually keep employees in the seats and keep them happy and energized and invigorated to drive value going forward? So, Chris, to your point, these 3 things don't operate in silos. In fact, one of the key takeaways from the report itself was we measured each of them against financial outcomes. And it was actually directly related to the last growth index that we did, which was on durable growth. So we looked at how our portfolio companies compound value over time. It's largely a combination of enterprise value, equity value, revenue growth, EBITDA margins, et cetera. And we determined that alignment alone doesn't have any correlation with financial outcomes. I guess said differently, it's table stakes. And it doesn't become obvious that you had misalignment until something bad happens. And so it's foundational to the calculus, but is not I would say it's a prerequisite, but it's not deterministic of the outcome. So that's kind of the base layer. Got to get alignment right first. Then the next step is efficiency. So again, it's how quickly can you convert, for example, sales and marketing dollars into revenue growth? A regression against efficiency by itself against those financial outcomes. And we got a little bit of a statistical correlation to those financial outcomes, but not something that was necessarily deterministic to suggest that efficiency alone was going to get you all the way to, where you need to be in terms of actually creating that value. Then we looked at sustainability. And again, it's sort of the same story. Sustainability was better than efficiency alone because it was more long dated in nature, where you can actually sustain a pace for 12 to 18 months. It's more likely to create value over time. But again, by itself, it wasn't necessarily something that was statistically correlated with a high degree of confidence in determining what a strong financial outcome was going to be. But where the heart of at least the initial part of the report got to was, if you combine alignment with efficiency and sustainability, and you create a composite score with those three outcomes, and then you run a regression against financial outcomes, it was highly statistically correlated with very low confidence error, and to suggest that there wasn't a lot of error around that regression itself, to suggest that it was directionally going to be very informative to helping a team that was motivated to create a financial outcome understand that if you were able to get alignment plus sustainability plus efficiency, you would achieve the end goal.
That sort of is the second finding, but I want to make sure we kind of drill down a little bit. But I think the way you described in the report is layering the three dimensions actually compounds healthy urgency. I think that's a different way of what you just said, but I want to make sure we sort of drill down on that, because it was kind of interesting. Almost half of the financial performance could be explained by bringing these together as opposed to pulling them apart. Is that a fair way to put it? And describe that a little more.
I think it was 38% specifically was the kind of the R squared, if you will. But then each of those individually were ranged between 0 and low 30s. And so it was each one of these things compounding together to create an outcome that, if you only had one of these various elements on their own, you wouldn't get to the same end result as if you're actually able to compound each of them on top of one another, to your point.
Now, we also drilled into kind of financial metrics or operating metrics that matter. One of the buzzwords, before we get into all kind of 5 of them and kind of what really stands out, 1 or 2 really stand out, I've sort of likened it to rule of 40. PE firms are constantly searching for ways to either, one, make things simple or create rules. There seems to be a sort of an emerging rule around retention in our business. For those listeners who haven't yet heard this, first of all, if you don't know what rule of 40 is, let's just back up. The combined percentage with which your growth plus or minus your EBITDA equals 40 or better, your rule of 40 business or better. Someone says it really should be rule of 50 or 60 to be sort of an outlier financial success. That's rule of 40. If you haven't heard of it, throw it in your favorite AI agent and you'll get more than you can imagine around rule of 40. Today, we're grappling with, in the age of AI, as PE investors, as other investors, what financial metrics stick out. One of the things that's beginning to be posited in our business, and Ben, feel free to jump on this, and we'll tie it back to the growth index, is retention. The idea, if I'm retaining customers, what I'm doing for my customers must not be replaceable by AI. Kind of simplistic, but that's what kind of people are grasping for. So far, you're nodding your head, so you agree you've been hearing this as well from our industry. Is that fair?
Yes, consistently. Yeah, in fact, I would say it's top of mind for many investors and many investment committees, even more so than other metrics that we could talk about here in a second.
Yeah, and that's like sort of without, giving up the answer before it even hatches. What you're hearing in our business is, without a certain threshold retention, and some would say without a certain gross retention, GRR versus NRR, we'll get into net and gross. Some firms aren't even going to invest in the business. They literally won't make it past a screen. Now, how true that is versus an interesting talking point, that may be eye of the beholder or maybe good marketing. But the point to the listener out there is, if you're running a company, a tech company, and you aren't absolutely all over retention, and we'll get to a punchline to the growth index as well in a minute, you're probably not going to get very far in a lot of firms' IC process, investment committee process, because retention has become the new rule of 40. Now, with that, I think the growth index looked at several financial dimensions, net and gross retention, revenue growth, EBITDA, and logo retention. I think those are the 5 kind of metrics we really drilled in around. You either go right to the punchline or talk about each, but I found all of it very interesting. So I'll kind of give the mic back to you and either go straight to the punchline or kind of build your way up. I'll dealer's choice, if you will.
I'll tee it up by saying we looked at many more than just 5 financial metrics, but the statistically significant ones, again, to financial outcomes, boiled down effectively to 5. And what was a bit surprising was that each of the retention metrics were the most important and the most correlated to financial outcomes. In particular, net revenue retention, which makes some intuitive sense. I'll come back to it in a second, but equally gross retention and logo retention as well. And I think going back to your earlier point, Chris, just around why this matters, especially in the age of AI, it really is a proxy, at least in my mind, for how mission critical your solution is for your customers, right? Like if customers aren't leaving, well, first of all, if you're attracting the right customers first, and then secondarily, they're not leaving, you have a formula for success. With AI, there's this whole notion that you're going to be able to produce, call it comparable offerings with less, but there's still friction associated with leaving a mission critical vendor and replacing it with something else. So the more mission critical, the more embedded you are, the harder it is to be disrupted, broadly speaking. And that really is what gets to the heart of gross revenue retention and logo revenue retention in particular. But the other nuance here that I think is especially important in the lower middle market is the element of net revenue retention. We're growth equity investors. We're all about growth. And I think we find that it's generally easier to grow an existing customer than it is to go on and find a new customer that fits your profile. You got to do both well, but you've already earned the trust of someone who's already subscribed to your solutions. You might as well offer as much value to them as you possibly can and align that value ultimately with what you charge. And that really is what net revenue retention dictates. And so, for example, if you have a 130% net revenue retention figure, you have a really fast head start on your budget for the year. If you're targeting 40, 50, 60, 70% growth, you're already halfway there at least with 130% net revenue retention. And when we looked at, again, the best performers in our portfolio, the common attribute was they had really strong gross and logo retention to be sure, but net revenue retention was the most statistically correlated toward financial performance and outcomes.
So what I just heard you say, if I can sort of play it back, we heard some of this rumbling in our industry because we often partially sell to larger PE firms, financial buyers, as we like to call them. And someone 6-9 months ago-ish said, hey, we got sort of the Mendoza line, to use a baseball term, of if you're not above this on GR,
Yeah.
NRR, we're not going further, as I just said. But it sounds like, based on the data that we found in our growth index, whether that was made up or not, it does appear to be pointing in the right direction, is I think what.
No question about it. Yeah. I mean, look, the Mendoza line is 90% gross revenue retention. And I think it's changed a little bit. I mean, I remember doing this 10 years ago, and 80 was kind of the Mendoza line. Anything north of 80, if it was in the 80s, like that was pretty strong. You started to ask questions if it was in the 70s, and it was going to be tough to rationalize the leaky bucket aspect of the customer base. It was below that. But I've certainly heard from colleagues in the market and our own investment committee that 90 is really the bar to beat.
Now let's dive in a little more, because you created this interesting, this sounds heavy Edison plug in the Electrifying Growth podcast, but I think it's because it's really good stuff. The survey kind of said there are certain behaviors that predict GRR, which I thought was interesting. The two that you kind of highlighted here were spend performance lift and proactive customer health. Let's take the first one, spend performance lift. What does that mean?
Yeah, so that is a proxy for how efficient the spend on general customer health is. Attracting new customers and retaining customers is on creating incremental dollars on a go-forward basis. So are you converting dollars allocated toward customers, broadly speaking, and creating a return, a multiple effect on those dollars? The reason why that's important, and there's actually derivatives of this, like, we talk about this on different boards all the time, but sales and marketing, or I guess selling to customers, isn't just about sales and marketing. It's also about product and technology. So you have to make sure that you have a function where you're listening to your customers and prospective customers and feeding that into your own spend formulas. And so the quantitative and the qualitative metrics that we measure on this particular unit was trying to get to the heart of that question. Are companies taking dollars, layering on top of that feedback that they're getting from their existing customers and the market, and invest it in a way that's creating a multiple effect on that spend.
Yeah, I'll bring sort of a best practice that seems to be either lost in the age of technology, maybe it got a little lost in the age of going remote, but QBRs, quarterly business reviews with your customers, particularly when you're selling at a high enough level. And what I mean by that is deal value. Some would say 100,000, some would say $1,000,000. Somewhere in between is probably the right answer. The point is, and I think what you're saying relative to the spend performance lift, it's not just sales and marketing where you sign a contract, you leave them alone. How are you really measuring ROI? Are you communicating with your customer? There's some old school tricks around the spend performance lift that some companies have either forgotten or never learned. If you're really a new company, I hate to say it, you're an AI native company, you might think human intervention or human contact may not be important, but that's just one very practical way I think
Yeah.
as someone who's been in this business a long time, you learn so much when you get your customers talking. And that can also be an unlock on this spend performance lift that's beyond sales and marketing, as you said. Now, this ties a little bit, maybe my clumsy way of tying to proactive customer health. Just talk about that one now as well.
Well, I guess if you don't mind, I don't want to take us down a rabbit hole, but just very quickly on the first one. Look, another topic that's coming up a lot is value-based pricing and
Yep.
consumption.
For perfect.
I think in the era of SaaS, it was all about seats. And that was kind of a proxy for value for a while, right? Like if you had more users, that was indicative that those users wanted to use your solution and you were creating value for them.
Yep.
That's no longer going to be sufficient or good enough going forward, especially as things get tokenized, agenticized. Folks are going to want to actually understand how those things are translated into value more specifically. And so this is getting to the heart of that question. It's where do customers derive value? And are you spending dollars to help them derive that value? And are you able to quantify that well? So I just wanted to say
No
that.
rabbit hole here. You know this because you've heard me say it. This becomes religion for some. I think some firms became affectionately say the SaaS bigots, some investors. Like if you're not a SaaS, pure play SaaS company, we can't invest in you. But AI is beginning to turn that on its head. And I tie it to what you just said, kind of like what happened with Apple and the phone, consumerization of business technology. AI is creating consumers of us all wanting to pay by the drink, you know,
Yeah.
and so I think what's to your point to tie it back, I think anyone who's still holding on to seat-based licensing as the only way they price or some kind of minimum, and the only way they price is with a fixed price, you're going to be disintermediated fast. You and I are on the same page on this. Some of the data proves that. That's not to say you should have a minimum with some kind of upcharge or some kind of per drink. That's what, frankly, some of the, both Anthropic and OpenAI are doing that to all of us, right? But we're also finding out the tokens are worth way more than the minimum that we're paying. So I don't think that's down a rabbit hole. But the point being for all those out there, if you're holding on to per seat or just a blanket, one size fits all price, you're probably a little late to the game of experimenting with pricing that makes more sense in the age of AI. Totally appreciate that comment. I think that's a really important one. Customer health. How do we get proactive about it?
The key question that we asked folks in our ecosystem was as follows. Is customer health signals, are you tracking them? And are they triggering anything proactive with respect to how you're managing customers? Or are you reactively firefighting any issues that arise when a customer sounds an alarm? And the R on this one, I believe, was like 59. And the R is related to gross revenue retention in this instance. So directionally informative of helping support revenue retention, in other words. So to measure proactive customer health, we focused really on a couple of things. The qualitative element was the following survey question. It's, are customer health signals being tracked? And are they triggering anything proactive? Or are you, as a company, just reacting to whatever a customer might complain about or sound an alarm about?
The next fire alarm of the day.
Exactly. And in this case, it was directionally very correlated to gross revenue retention, as you might expect. Companies that are proactively tracking how customers are experiencing their products and solutions tend to manage them and retain them better, make them happy over time. And what was interesting about this one was that it wasn't just the notion that companies that are being proactive in managing their customers are retaining them better. It's that if you layer on top of the fact that we just talked about with respect to the spend performance lift, it then becomes very statistically relevant to retention. So if you layer on top of the fact that you are being proactive in managing your customer health and keeping them very satisfied and listening to them and then spending to continue to make them happy. Those are the two things that we've tracked in this study that led to the highest measures of gross revenue retention in our portfolio. And again, with net revenue retention, those are the two things that stood out most to us as statistically deterministic, ultimately, to financial outcomes and success.
And some may say that sounds so obvious, but here we are eating our own, cooking, if you will, but also criticizing our own sort of engagement at our portfolio companies levels, not sharing enough about this idea of getting with your customer, measuring ROI, really making sure you're hearing directly from them. Again, I think there's a bit of symptomatic of technology can do it. The customer's supposed to be happy if they're paying. There's some devil in those details, if you will, that came through.
Absolutely. And it's circular to a certain point. All these things feed on each other. And if you create that flywheel, that's what will really create a lot of momentum in retaining your customer base and ultimately adding value to your customers and encouraging them to trust and spend more with you over time.
Now, not shifting gears, but because as we're recording this, OpenAI announced it's filing, to go public, and we're in the midst of unbelievable change in the age of AI, creating fear, uncertainty, and doubt, creating lots of, questions about how fast are we going, et cetera. This was not an AI growth index, but we couldn't help but ask ourselves and our portfolio companies how AI is impacting our companies. You guys called it, you guys being those who, kind of wrote this index, the AI paradox. And there's some counterintuitiveness, which is, it's always good when you can say there's something that wasn't quite as it might have seemed, but even more so as it relates to AI. So what is the AI paradox?
It's not that the best companies are the best because of AI. It's that the companies that have the most healthy urgency are able to deploy AI in a way that creates incremental value. So said differently, it's kind of flipped on its head. I think there was an intuition that we had that the best companies were the ones that were using AI the most right now and incorporating it. It was actually, the finding was less about that and more about the companies that had the healthy urgency as being the ones that were able to most quickly and most nimbly deploy AI in a way that created value.
It's simplistic in a way, but I like this sort of very declarative. AI is not a fourth dimension or the fourth dimension of healthy urgency. What do you mean by that?
It's a compounder, said differently. To be able to deploy AI well, you have to have healthy urgency first. In other words, you need to have the table stakes alignments. You need to have created some degree of momentum with efficiency. And then you needed to actually build a team that was able to sustain a pace for a long enough period of time to then leverage AI well. And if you don't have healthy urgency and you just immediately try to jump to incorporating AI, it's quite possible you're going to do so in a misaligned way. You'll have people within the organization using it for different purposes, and they won't speak to one another. And that actually create more damage than good. And so the message that we found when we actually studied this was, it's great. Sort of patting ourselves on the back for a second. 93% of our portfolio companies are using AI well already, which is remarkable. And it's a kudos to the teams that we have. But the finding was a layer deeper. And it's that as we actually begun to look into how it's being used, the folks that are using it the best are the folks and the organizations that already have healthy urgency. And the companies that need a little bit of help inside our portfolio and otherwise are the ones that haven't been able to create that healthy urgency flywheel and have individual stakeholders using AI, but not necessarily at an organizationally sponsored level that suggests that it's in the same direction.
Now, a line I liked that I heard you share in our annual meeting last month, you just said it compounds, but I think to be really specific and just dive into this a second longer, it compounds the condition you already have, good and bad, I think is the way you described it. And so let's take a bad first and maybe a good second. But if you got an organization that's not sustainable, that's heading towards burnout, maybe this is obvious, maybe it's not, but your contention would be, the data would say AI actually speeds that up. Is that the way to think about it?
Yeah. The irony is that there's this fear that AI is going to replace everyone's job. And Look, there's probably an element of truth to that. And we're all finding our own daily uses of AI that it's doing things that, that would take us a lot more time to do ourselves. But with respect to burnout, the element that's related to I think in particular is that if you're continuing to use AI to replace yourself and you're not doing that in a way that is co-aligned with your rest of your colleagues, that's going to end up creating more work for everyone. And if you're creating more work for everyone, inevitably you're going to get burned out as a result of that.
And at the same token, you make the point that any one of these three elements of, alignment, efficiency, or sustainability don't really survive on their own or act on their own. Okay, fine. But I think what you said was a highly aligned organization, or maybe you should say a healthy, urgent organization will go faster. That'll compound as well, kind of on the good side.
I think we all have, everyone within our organization. I have a lot of friends who are in organizations that use AI pervasively. Going back to the earlier point, it's very similar to the efficiency one. If you use an AI poorly and you're having it automate tasks that you have that other people are reliant on, and then you're sending it over the fence and it wasn't done in a thoughtful way, it's creating more work for your colleagues.
Yeah.
On the flip side, if you have an aligned mission statement on how AI should be used across the organization, and you understand how one workflow feeds into the next, and you're intentional about how AI translates across the organization, and you're mission driven to ensure that the transition from one person to the next is clear and coherent, then it can create efficiencies and flywheels that accelerate everyone's work in a productive way.
Excellent. That's really helpful. Again, I'll plug the Growth Index, Edison Partners website. It's out there. You can download it. I like that you concluded, and in my opinion, you concluded with, 8 steps. This isn't a 12-step program. It's an 8-step program. But the thing I don't want to do it through all 8, because again, don't give it all away here for free. Come download it. It's free anyway on the website. But I think there were a couple that I want to double click on. One specifically, and there's a couple more, the board and the ELT, not just ELT down. Let me just talk about that for a second.
Yeah, it's funny because I felt like I might have unintentionally minimized the importance of alignment by saying there's no correlation with alignment to financial outcomes. But I want to reemphasize that it's foundational and it's table stakes, and you need to be aligned for anything else to work. This is really a proxy as it relates to that. It's active communication and active expectation setting across the stakeholder base, and ensuring that the board is aligned on what the priorities are. The CEO understands and is aligned with those priorities and is able to communicate those to the ELT members. And there's no slippage with respect to what those objectives are, so that ultimately they can continue to get communicated down to the organization. So the recommendation, I think specifically, is a frequent cadence, quarterly at a minimum, and a proactive dialogue about what the expectations are, and then the objectives, so that alignment can sustain and endure, and ultimately be communicated to everyone in the organization who needs to be rowing in the same direction.
The second one I want to call out, because again, AI seems to be on the tip of everyone's tongue, is you said, classify your AI adoption honestly.
Yeah. So we found, as a part of the study, there's really 3 categories of AI adopters currently. The first one are systemic adopters, the second are functional, and the third are incipient. Really, just in short, the difference is how pervasive is the AI usage across the organization? How much alignment is that usage ultimately received? In other words, for systemic adopters, is it truly systemic throughout the organization? Do folks understand, again, going back to the workflow example, how AI usage in one part of the organization translates to the next and translates to another area, and that compounds? Functional AI adoption is silos. So folks within the organization are using AI for their own individual purposes, but it doesn't necessarily feed the wheel or create that flywheel compounding effect. And then incipient is still early experimentation only, trying to figure out how AI adds value. And so the point here is be self-reflective and honest with yourself. Where is your organization in sort of this 3-parted hierarchy? And what can you do to make it more systemic? How can you create the sponsorship across the organization, across the ELT level? And how can your ELT leaders help their staffs ultimately be more systemic around usage and create that efficiencies across the organization, so that one use feeds into the next and feeds into the next, and that compounds over time?
You use that last word. We call these systemic ones AI compounders. The AI is literally compounding growth and becoming true leverage for the companies. And for those out there who are wondering what our portfolio is up to, less than 10% were incipients, and the balance are kind of split between systemic and functional. I think what I've seen, just sort of the anecdotal level for the companies I work with, because we did bring it back to a portfolio company level, functional is the obvious one. Can I save some money? So quite frankly, if you're out there and you haven't at least gotten to that level where you're, being more efficient, get there quickly. Otherwise you're an incipient. But as Ben is describing, as the growth index describes, it's harder to be a compounder. You won't be a compounder if you're not aligned. I guess I'll say it that way. So get aligned and then let it flow. One that's a hot topic, and we'll conclude on this one and any of the thoughts you might have on the growth index. But those who have heard, there were people at Google gaming the token usage sort of incentive. Uber's blown its budget on tokens. We had a very simple statement here, which I think is a good one. Apply the 2-quarter ROI test. And we call it the 2-quarter because we refer to that in our shop. But the 2-quarter ROI test to AI spend the same way you might apply it to headcount relative to sales and marketing. Sounds obvious, maybe, but I maybe just want to restate it. But talk about what you might do to make sure your AI doesn't become like the McKinsey study that says 95% are wasted.
Absolutely. I mean, one of the metrics that we measured and evaluated and continue to think about a lot is ARR per head, right? Like, are you able to maximize your HR resources to create value for your customers and revenue as a result of that? This is similar to that. Are you able to take your AI spend and create value on that as well? And, the reality is there isn't a tremendous amount of transparency yet with token use and cost. There's a huge opportunity, I think, for someone to solve that problem. But for companies that are using AI in any use case at an enterprise level, need to be really tracking how it's used. Because the reality is, even systemic companies, AI compounders, are still experimenting. And it's healthy. We have to continue to experiment to learn how we can actually create value. But that experimentation comes at a cost. And unless it's managed proactively and there are guardrails around that, it can create some real issues from a spend management standpoint. So to your point on how you describe this, Chris, yeah, I mean, we track headcount to ARR as religion in portfolio companies generally, and then make sure that we're creating operating efficiencies as a result of that. AI spend should be thought of very similarly.
That's really good stuff. Closing comments on the growth index, and maybe we just sort of did that with a couple of underlines, but maybe just in your mind, also maybe a plug for the growth index, but just how will you summarize, or what were you surprised by, just to kind of conclude here this discussion?
Well, look, none of it would have been possible without the feedback from our portfolio companies. So thank you for the continued engagement and trust. Look, I think the biggest takeaway is a fixation on retention as a standout. I mean, we talked about durable growth last year, and that was largely revenue growth and EBITDA margins. Retention, especially in this age of AI and disruption, is huge. And the way that you ultimately get successful retention over time is to speak with your customers and understand the health and make sure that you're spending dollars to drive value and that your pricing ultimately is aligned with the value that you're offering. And you're creating a feedback loop so that you can ensure that over time, 3 months, 6 months, that spend is creating revenue and it sustains beyond that, 12, 18 months. If you do that, you'll create healthy urgency in your organizations. And if you create healthy urgency, you'll be in a much better place to deploy AI well.
Well said. Thanks for the time. It's interesting. You opened early in this discussion up sort of this slide we used at the annual meeting. The more things change, the more they stay the same. What's interesting is I can go back, for better or worse, more than a couple decades. I'm asking our portfolio companies or prospects, those who haven't taken any money yet, how do you communicate with your customers? How do you know they're happy, et cetera? NPS was a thing, still is a thing. Surveys is a thing, were a thing. QBRs, I mentioned earlier. But I'll tell you how often it still is today, the lack of sort of a systemic, use your word, process for communicating with your customers and your customers communicate to you. That'd be my parting shot to those out there. If retention is that important, your customers will tell you if you just ask them. The problem is they want to be asked. They don't want to fill out a survey, and I can't do it for you. I guess I would leave with, sort of what may sound like a bit of an old school thought.
getting with your customers to review some of these key things Ben and our growth index told us is probably the biggest thing you can do to quickly find out if you got a potential retention problem on the horizon, or if you have one now, get out there and talk to them. You're a little late, but be proactive on this. But excellent work, Ben and team, as you said. Thank you to portfolio companies. And Ben Laufer, thanks for joining Electrifying Growth. Good conversation.
Thanks for having me. Appreciate it.
Thank you for joining this episode of Electrifying Growth. A special thanks to this week's guest for sharing their time and insight. For more resources, inspiration, and a look inside the Edison Partners network, sign up for our newsletter at www.edisonpartners.com. Click on the Stay in the Know button in the top right corner of our webpage. Thank you again.